What's the typical risk reward ratio of a successful trader?
But in all reality, I want to risk 1 to make 50.
Like out of 10 trades, how many trades will be right?
I've noticed a lot of the base breakouts that fail will try a second time, sometimes a third or a fourth time before they actually work.
Can we take some examples of Indian stocks and discuss this concept again?
First, I'll always look what's the personality of the stock, how does it trade?
How about exit? Would you exit at one price or you also stays the exit? I want to pick your brain on pyramiding. So what is going to be the quantum of pyramiding? How does it work, the ratio? How do you measure relative strength in a monthly chart and weekly chart and daily? Are the formulas the same or a different formula you select? Hello traders, face-to-face global this time, and this time I got hold of a trader who is around 53-year-old who has worked with William O'Neill organization, and he has really good understanding about charts, how to read charts, how to use relative strength to find out opportunities in chart. Very interesting. It's a very short video, 50-minute video, but I think if you go through that video, you will get something which will be relevant for you, especially if you are a relative strength practitioner like me. All right, so let's welcome our friend for this face-to-face, Mr. Ross. Hello, Mr. Ross. How are you doing? Good to have you.
Hi, good. Thanks for having me. How are you today?
Amazing. And now I think I'll be very, very excited because coming 60 minutes, there's a lot of learning from you. And you have promised me that you are not going to hide anything. You're going to get everything what I want from you.
Any questions you want to answer? I'm not sandbagging anything. So yep, ask away. If I'm not being clear, please ask. I will clarify. Yeah.
Awesome. Thank you. I really appreciate this from you. Ross, we'd love to know more about you, your journey. How did it all start? Markets, trading, making money from trading, everything. Tell us right from your college days. Take us.
Yeah, I'll keep it short and sweet. So I always say I was smart enough to make my luck work for me. I finished business school at University of Florida. I took a job as a retail stockbroker. I learned that business, but I was fortunate enough that when I started that in my very first job out of college, before the Series 7 study manual, they gave me How to Make Money in Stocks by William J. O'Neill.
Oh, wow.
Long story. Yeah, so that was my very first book I read about the market out of college. And within 3 years, I met a client along the way who was a big O'Neill fan, had been to all of his workshops. So we used to talk about Can Slim and that sort of thing. And one day she just called me up. I was sitting in Miami and said, "How'd you like to go work for Bill O'Neill out in California?" I was like, "You got to be kidding me." So long story short, within 3 years of having that book handed to me, I got a job working for William O'Neill Institutional Sales.
Oh, amazing.
Yeah. And then within that first year, I had a hedge fund client that I developed a nice relationship with. He offered me a position to run his fund with him. And so when I came in to resign, William O'Neill, we call Bill, right? So when I say Bill, that's who I'm referring to. So Bill came into the office, we sat down in the conference room, and he gave me a very nice offer to stay and run money for the firm. And so the gentleman who was originally going to hire me, you don't turn that down. The door's always open. We remain great friends to this day. So I'm almost done now. I won't bore you too long. And so I was very fortunate. So I was with O'Neill for 5 years. Within a year, I became a portfolio manager. I was very lucky to be there during that 98 through 2000 bull market run. During that time also, so I got to do wonderful things. I built my first model book with a couple of the other PMs there for Bill O'Neill, which is kind of a big thing to work on a firm model book. So I thought that was cool. I got Bill's perspective. I got to teach the workshops with him around the country. I got to build a track record. And then, and we're over at this point, I wound up hooking up with one of the clients of William O'Neill, who was a Fidelity. He was the mid-cap growth fund manager at Fidelity, and we ran a fund together in New York for 6 years, right? So,
Wow.
and since then, I run my own money. I'm just a private investor, and I've worked with, I say that, the guys who I'm working with now, the younger guys, Nick, Richard, and Rye, who are all, they're like I wouldn't say my kids, they're like my new little brothers, so we make a nice, big, happy family. And so that's it. Now I still live and breathe the market every day.
Superb, superb. You have two ways to remain young. One is being an active market participant. It gives you a feeling of being young and relevant. And second, you're working with younger people, which is obviously giving you a reasons to remain young because you need to match their pace, right?
Yeah, absolutely. They keep me going. They're
this is great.
Amazing.
I mean, Richard, had an opportunity to interview Richard for my face-to-face series. He is doing awesome job. I think all of you at Traders Lion, you guys are doing amazing job for global investors and traders. So thank you so much for doing what you guys are doing.
Oh, thank you very much. I appreciate that. Yep, I'm glad the young guys keep me around.
Yeah, amazing. But you are very young as well. No, I don't think so. Anyone can guess your age. So let's keep it parked for offline discussion someday.
Okay, I'm happy to share. I'm 53 years old.
Oh, that's nice. That's good. Well done, Ross. Ross, so as I said that I'm here to take a lot from you. Your journey is incredible. It's very inspiring. And I'm sure people in India who look up to role models, especially from US, because traders from US are amazing. I got an opportunity to interact with Mr. Mark Minervini and other people, and it's a blessing to be around and living in an era when these amazing humans exist. So we'd love to know more about how you trade, how has been your learning from William O'Neill, and what exactly is the setup which you use to trade. I know that you have taken some Indian stock examples as well, but first let us go through some US stock examples, and then you can take us through the Indian stock examples with the exact framework which you have to participate.
I didn't even have necessarily specific Indian stock examples so much as I was telling you. I went through the Indian market with a friend of mine just to see what was going on. I thought you had specific stocks maybe you wanted me to go through. So, but anyway, when we get there, we can do that as well. So I have a few written down that I just, we can talk industry groups. What I saw was strong, but I don't have any timely setups per se for India. I did not screen to go through.
So that gives me liberty to ask whatever I want to ask. I'll give you stock.
Oh, absolutely, absolutely.
Tracking. So it will be a good interaction with you then. So, but let's talk about your setup first, and you can take US stock as an example to explain that.
Sure. So, starting here, we're using the QQQ, which is the ETF or tracking index for the Nasdaq. Okay. This is the Nasdaq and S&P 500. And so, let me tell you, this is what I say. William O'Neill, Bill, he created the wheel. All I've done is put a cool rim on it, maybe a low profile tire, and, change the size, whatever. So I will say what I do is still 95% what Bill wrote in his book. And I've just kind of, this is what I'll tell anyone: find a methodology that's proven, like Bill's, there's many out there, and make it your own. When you have finally molded those rules to make it fit your personality is when you've kind of got it down. That being said, the first thing I always look at is the market, the M in CAN SLIM. What's the market doing? Are we in an uptrend, right? I have a very specific way, and we're not going to get into it for lack of time today, but for figuring out when a new uptrend. Go ahead.
No lack of time.
Oh, okay.
I have no limit. Just please continue.
Okay. So the follow through day concept is something that I learned from Bill for figuring out when a new uptrend begins. So I'll give you this much: there's never been a new uptrend or new bull market in history that wasn't preceded by a follow-through day. However, not every follow-through day leads to a new uptrend, right? So there are failed follow-through days. And I would say the older I get, the more confident I get in this. The clear differentiator that will always, and you've got to get good, experience and time helps. It took me time to figure it out, but it's the qualitative clues, not the right? At the end of the day, everyone can learn the rules. Everyone's going to ultimately start to come up with the same numbers quantitatively, right? Especially now with AI, no one's getting the wrong answer anymore, so to speak. So it comes down to the qualitative. How's the market behaving? This is my always say, follow the leaders, watch the leaders. What are the leaders doing? That will always tell you. And what I mean by that, what are the leading traditional growth stocks doing? Where are they in their overall cycle, right? Are they in early stage basis? Are they later in the cycle? And if there are stocks that were leading that are getting later in the cycle, how healthy is rotation? Do you see a plethora of other stocks that are setting up to take their place? Those are usually the areas that money rotates to.
Okay.
Yeah. So as long as you're seeing what I call strong, healthy leadership, healthy rotation, those are the follow-through days that work. The follow-through days that don't work, because what happens is as you go along, what gets you out of the market every time. So we say we buy on fundamentals and technicals, but we sell only on technicals. And that's because it can take a very long time for the fundamentals to catch up. For example, I'll give you Cisco Systems topped in, 99, 2000. Its earnings continued to look phenomenal, maybe for 6-8 quarters after it fell 80%, right? So that's why we buy on both fundamentals and technicals. We sell only on technicals. And in the same way, I'll tell you what, in 2008, our fund was up for the year. I got out at the top. All of that profit was from me keeping my long profit from the beginning of the year and sitting in cash. But there was no magic to spotting that top. It was crystal clear. There were no setups, and I mean none, for not any traditional growth, nothing cyclical, nothing. I mean, the best long setups were inverse ETFs, right?
Okay.
To give you an idea. So likewise, the follow-through days are the ones where leadership is, all the setups are beginning to happen, right?
Okay.
And I'll show you my sweet spot regarding this area.
Yes, Ross, I will keep on asking you. Sorry, I hate to do this, but that's my job. I will keep on interrupting you in the middle and ask you a few questions which may be trivial and basics. Yeah.
Don't hesitate to interrupt. Just stop me.
Thank you so much. Thank you. I really appreciate this. So Ross, follow through. Can you please objectively explain this? What exactly is it?
So a follow through day is when we're watching the market come down and down and down, basically every time the market stops along the way and rallies one day, I start to count rally days.
Okay.
So a follow-through day happens the ideal follow-through day happens between days 4 and 7 of a rally attempt, but they can happen later. You can have a day 23 follow-through day that is just as valid.
Okay.
So on that day, either the NASDAQ or S&P 500, only those two indexes must rise a minimum of 1.75% on more volume than the previous day.
Okay.
Now, an ideal follow-through day will have overwhelming volume. However, there are follow-through days that happen, way out past days 4 through 7. Volume is bigger than the previous day, but significantly less than average. And that hasn't mattered, right? So I will tell you every time it's a phenomenal quantitative clue, but the qualitative matters a whole lot there. So when a follow-through day happens, it's very easy, right? Investors Business Daily will let you know. Probably everyone on Twitter will let you know. It's a well-known thing, but the trick is, what does leadership look like? Does it look right? Is leadership going to support a new uptrend from here? In general, any healthy, sustainable uptrends typically led by at least 2 or 3 powerful industry groups, and the more now we've got super broad leadership, but in a less broad, thin, more narrowly led market, I've seen is a few tech groups, maybe a little healthcare and some specialty retail can hold up the market for quite a while at the end of a bull run. In the beginning, maybe that would get you started, and then you want to see it broaden out like we have. I will now between the AI, quantum, and all of the associated alternative power to run that stuff is off the charts right now. Not to mention, I see biotech stocks exploding everywhere, right? And I'm assuming, I don't know, but the quantum and AI is going to be a big driver behind a lot of those biotech pharmaceutical stocks, and us ultimately being healthier, maybe even curing some diseases instead of just treating the symptoms. You know what I mean?
Okay. I want to stop you here. And again, going back to that follow through. So what's the difference between follow through and reversal?
Follow through
and reversal. So
you mean so spotting the top?
Reversal is spotting the top.
Is that what you're at? So that's a whole. So yeah, that for looking at the top of the market, that is going to be. So what I'll start to look through, and it doesn't. So the first thing I count distribution day after the market's in an uptrend. I'm always following distribution days. Anytime the market falls on at least 0.2 or more percent and has a poor closing range matters on heavier volume, I'll take note of that. Now mind here, when I say the close matters, this day right here was down 0.67%, volume was bigger. However, you notice how it closes in the upper half of the range and above the purple line here? That purple line that's a key moving average, at least for me. It's the 23 exponential. Let me, here's all of so you can see what I've got going on here. The Cayenne line, which you see overlapping the purple, is the 21-day simple moving average. The purple line, the 23 exponential. You'll see here, this gray line is the 50 simple, and this peach or orange line is the 65 exponential. Okay. And I keep those on. I have noticed that a lot of stocks that don't hold their 21-day will get support at the 23 exponential, and the same with the 50. A lot of stocks that don't hold the 50 simple wind up getting support at the 65 exponential. Okay. And anyway, so that's just my thing. Honestly, I think moving averages are personal to an extent, right? There are certain, but that's what I don't want to get carried away on moving averages. I just wanted you to see what I'm saying here is this right here is, even though this fits, if you were to, according to William O'Neill's book, this is a distribution day. According to Ross Haber, this is an accumulation day. Okay. It shook out, closed back in the top third of the range, above mid-range, as well as above that key moving average. So while that absolutely is that meets the definition of distribution, I always say you've got to be the closing range matters, because this closing range on the higher volume, this is actually showing you accumulation. Not to mention, it looks like it might even be an outside day to boot. Does that make sense? So what the difference between a day that like this, that falls, closes on the lows and picks up volume, is much different than the ones that right here. This would be a distribution day because it closed down 0.43% on heavier volume. However, you notice how it closes almost back near the high. That's a cumulative action. That's a shake. That's, that would be a hammer candle.
Okay.
So I don't want to get, so I start counting distribution days, and then I look for clusters of distribution. Once I see a cluster of distribution, now again, I'm watching where are the setups in traditional growth stocks? That's the big thing. You'll see it. My whole thing is, and it sounds like a huge blow off answer, right? I would ask the older guys. I'd ask Bill O'Neill. I'd ask the guys who had been there for a while. What do you think of the market? And it seemed like such a blow off answer at the time. They'd always tell me, Ross, what are the leaders doing? Watch the leaders. And it finally sunk in over time after, going on 30 years now. that is the clue every time. So if I'm paying close attention, so that's when I scan, basically I say I have the luxury of being able to watch the market every day. I love to do it. So I feel lucky to be able to do it. And I'm screening the market all day. I have a favorite screen called Up on Volume. Very simple, right? It's a preset screen inside of Deep View. Happy to share it with here. And if we wanted to go to it, Up on Volume, and we can see, if you want to see, here are the criteria.
I just a minute. I see in your template you have a monthly chart, weekly chart, and daily chart.
Yes.
And there is something called relative strength line also on the top. So could you just help me with the
yes.
template?
So this is relative strength line up here, which is a key. Relative strength is a big part of, Can Slim and what I learned from Bill O'Neill. This is just price, right? Regular bar charts. I use high, low, close. Oh, I'm sorry. Instead of open, high, low, close. Why? Because that's what I learned on and my eye got used to.
Okay.
However, so that again, this is personal. A lot of guys, prefer the candlesticks or open, high, low, close, so they can see both. This is just what my eyes got used to. So I don't think there's a right or wrong, just whatever works for you.
Okay.
And then to keep it very simple and basic, I would even say this is what I used to keep on here. A 10-day simple,
Okay.
21-day simple,
Okay.
50-day simple, 200-day simple.
Okay.
And that was it.
Okay.
And then I over time, recently, you could say, let's say over the last decade or so, 15 years, I added the exponentials, the 23 and the 65.
Okay.
But honestly, that just adds noise to your chart. It works for me, but I would suggest a cleaner chart like this. And then as far as adding anything else,
okay,
make that a personal, right? Like make it your own. And this is just volume down here with this should be a 50-day moving average line, right? Yep.
Okay.
Moving average line. So pink or red days are down, blue days are up. Simple moving averages. And this X here is very recent. That lets me know. So there's an indicator that we have, called relative measured volatility.
Okay.
And what this black X is letting me know every time. So it measures relative volatility, right? It shows you the tight areas in a stock, which normally you can see, but in a wide and loose stock, it kind of lets you know things. So it lets you know things are tightening up on a relative basis. I'll be honest with you. I don't make, it's something I've just been looking at recently. I could do with it. I'm not using it to make decisions. It's just letting me notice that anywhere there's X's, it's where this line is down in these green, yellow, and pink bands. Anytime the line is down here, it's letting you know tight price action.
Oh, it's basically like a Bollinger. It's like a Bollinger band that it's getting squeezed.
Yeah, well, it does, except that I guess, yes, because the Bollinger Bands, yes, tighten when, narrow when price tightens. So something, yes, similar concept, I guess. But since I like clean charts and I don't like all of this, I want to, every time this is in this band, right?
Okay.
I get a black X here. So to clean up my chart, I keep that gone. And I know that anytime I see the black X underneath price, that relative measured volatility is in that band of tightness.
Okay. And your weekly and the monthly template, why do you have to look at the weekly and monthly chart? What do you do with that?
So basically it's, right, it's all fractal. The same way you wouldn't make decisions on intraday charts without looking at the daily.
Okay.
I watch the daily relative to the weekly and the monthly, right? So I love big IPO base breakouts. Also, I don't know if you're familiar with a gentleman, Dr. Wish, here in America. He was Richard Moglen's professor. he has what he calls, it's any base longer than 3 months breaking out to new all-time highs is what he calls a green line breakout. They have tremendous success of, especially when you're picking ones in a bull market that meet the CAN-SLIM fundamentals, specifically if they're in an industry group. So industry group is a very big part of what I do. And this is a William O'Neill study right here. 49% of a stock's move is directly related to its industry group and sector.
Okay.
37% related to the industry group, 12% sector.
Okay.
Yeah, 49%. So almost half. So when I'm watching, that's also a big thing. I love watching groups of stocks move together. Like I'll always tell you that I'll buy the bridesmaid, so to speak, in a powerful group rather than the most sound company with the best CAN-SLIM fundamentals and high relative strength in a group that's not working.
Okay,
the group is a big deal. So,
how do you measure relative strength in a monthly chart and weekly chart and daily? Are the formula is the same or a different formula you select?
No, it should be exactly the same for simple relative strength. I'm drawing a blank on it now. It's a very simple formula. And for the relative strength line. And so now, mind you, there's a relative strength rating I don't pay much attention to. I find the line is the purest way. My favorite, one of my favorite things to see, especially, and that I'm always looking for, is a relative strength line that's making new highs before price.
Okay.
We got to go back. I'm trying to remember maybe it was all the way back to 2020. Yeah, it was back in here. And so you'll start to, you see up here, the pink circles, that's letting you know. So if I go back to the relative strength all-time high here and I draw a line, you can see how the relative strength line is making a new all-time high, right? And in these areas, but you see price on a relative basis here.
The relative strength which is calculated here is vis-a-vis S&P 500, as I can see.
Correct.
Is it a simple price of the stock divided by the price of S&P 500?
Pretty much, yes.
Okay.
Yep.
So the stock price making new high and relative strength making new high, that's a strong enough reason to participate in that stock.
In O'Neill's book, you want to see the relative strength line at least making new highs with the price. What I'm going to tell you is when you see a relative strength line start making new all-time highs before the price, you see how you don't get new highs in price until all the way over here.
Okay.
So when the relative strength line is screaming, look at me, I'm already at new all-time highs. And when the market gets going, the likelihood of that stock following the relative strength line higher is pretty damn good. So I was buying this super early before it got going because of the relative strength line. So this is just one I remembered off the top of my head. I want to say it might have been Zoom, which we're on now. That was the other one that did the similar back in 2020. But I won't go again and waste time. But that's so when I say relative strength, so especially when the market is weak, right? When the S&P is going down and I'm seeing stocks start to diverge, you'll see it in the relative strength line. You're basically looking for the groups of stocks that are diverging on a positive basis. That relative strength line lets you know.
Okay.
It lets you know the strongest stocks and the strongest groups. And if you're watching, like I do, the groups of stocks together, you'll see them all moving together. So when I see all of the semiconductors, Tesla's kind of hard. It's in and of itself, right? There's maybe Rivian. It doesn't have much in the electric car market as competition. Most of it's in China. But if you go into semiconductors, let's say I'm going to make it up. I see NVIDIA or AVGO relative strength line making new all-time highs, I'm going to bet you that I can find, at the beginning of a new bull market, some other leaders that have relative strength lines that are, diverging positively. So that's really what I'm looking for. The more I see traditional growth stocks forming sound bases in groups, especially with powerful relative strength lines. Now, keep in right, and it makes sense when the market's coming down, right? When the market is weak, that's when the strongest stocks have the most power, right? The relative strength lines really pop up versus a weak market, right? Whereas in a powerful bull market, it's harder to find them right on a relative.
So
relative. So
how do you manage? How do you manage your position when market is going down? The relative strength line can still be positive, but the stock price is going down because market is going down.
All right. So going back to the beginning, I watch for follow-through days. Once I know I've got a valid follow-through day and we're in an uptrend, I immediately look at what are the groups of traditional growth stocks, what are the highest quality, most liquid ones and to me, personality of a stock makes a difference. I like stocks that trade, liquid stocks that trade nice tight ranges, respect logical levels of support, such as the tops of prior bases, significant swing highs and lows, key moving averages, highs and lows of gaps, those sort of things. So, for example, the big liquid ones, like I said before, the NVIDIAs, which might be a little slow, the AVGOs, the ones that once they break out, trade in relatively tight ranges, exhibit tight closes. They have that organized pattern. I've noticed making model books, looking at what Bill O'Neill used to put most of his money into, because he put all of his money into one or two stocks. It was always a stock with one of those personalities. That it was never something that traded like this. And it's harder to see here, but this wide, loose, whippy, back and forth, it would always be. I'm trying to think what's the. Here, let's just go to NVIDIA at the moment. You see how NVIDIA, once it goes, it's much tighter. This is the 10-day simple moving average. So notice how it respects that line all the way till here. So what gets me out of a stock now, and this I've picked up from Rye, I used to try and hold the stock through pullbacks to the 50-day moving average. No longer. You see this cayenne line or this light blue line under the green line, that's the 21-day simple. Now, as soon as I see two closes below, I'm out. And depending on how a stock respects key moving averages, I might break that up a little bit. But in general, I noticed that Bill O'Neill looks for these tight trading stocks that tend to respect key levels. He's the king. He can hold them for years through these wild pullbacks. I find I wind up getting shaken out and have to buy them back again anyway. So since I've learned there's only one William O'Neill, I like raise two closes below the 21-day moving average, and then I'm out until it sets up again.
Can we take some examples of Indian stocks and discuss this concept again? Is this software equipped with Indian stocks?
I'm sorry?
Can we discuss some Indian stocks?
Yeah. So I'm going to trade. Let me ask you this. Is it easy for you to share? Do you want to pull up the stocks?
Sure. But I don't have the relative strength template, which, you have it.
Okay. Let me do this. I have a free trading view account, which has the relative strength on it. So
sure.
Let me share that, and then you can tell me.
Okay, so this relative strength is the trader's line relative strength, which is there in trading.
Oh yeah, if you can put it on the trader line relative strength, that would do it, and then we can use your screen instead.
Okay, you wanted me to do that. Okay, let me just.
Right. Okay. You can see here. This is this is one that I've been talking about with my buddy Dinesh Garuda. But yeah. Please, you guide me. I had noticed, right? So in India, from like a lot of the same stuff, pharmaceuticals, anyway, you guide me.
Okay, so let me give you stock name because you have TradingView.
Oh, do you want me to put that
Yeah,
back?
I think you continue
Okay.
with your screen sharing. Let me
Okay.
give you certain stocks which you
Okay.
may like to discuss. So let's start with IIFL.
S
IIFL.
IIFL.
Yeah. Okay, we have to go to stock. Okay, can you see the stock? Yeah. What's the price? Can you just select the stock? Yeah. Can you remove USA down
Oh,
there?
yes, of course. Thank you.
Yeah,
There
they
we
are
go.
in full finance. Yeah, let's see. Let's go inside this.
IIFL. Is that the wrong stock?
Yes, it's the same stock, I guess. Now you tell me, what's your view on this based on your setup?
Gotcha.
Would
So I've got no moving averages on here. So basically what I'm
you
looking
like
at
to
here,
add moving averages?
I would love to, but since it's a
Oh,
free account,
got it. Okay, that's okay.
right? I can only add
That's
so
okay.
many.
I mean, not a problem. I think moving average will be anyways
So
favorable.
here's what I would tell you on something like this. Okay. So this right now is trying to, from a breakout to new all-time highs point of view, that this seems to be, or a 52-week highs, I'm sorry, because it's definitely
Okay.
not an all-time high.
Yeah.
So here, the first thing I see, so let's say, you were catching the market following through, right? My favorite setup is, okay, so this is where I've kind of made things my own. I mixed Bill O'Neill with
Okay.
Stan Weinstein, okay? Bill
Okay.
O'Neill doesn't like buying down here. However, Stan Weinstein buys everything down here. So while their methodologies have so much in common, their entry areas are completely different. So to Bill O'Neill, this is junk off the bottom. To Stan Weinstein, it's his go. So what happened was when I left O'Neill, where I was trading much less money than when I was running the hedge fund, I had to figure out I could not buy 500,000 shares of a stock at the market on a breakout like this because, and especially now with all the HFTs and algos and buying these breakouts does work still, where they just break out and go, but they're much harder. And once you are managing, $1 billion or more, using market orders to buy breakouts is not a feasible strategy anymore. So I kind of mishmashed my Bill O'Neill with Stan Weinstein. And so while we don't have the moving averages on here, if you could imagine at this point, when the stock is at this point, the moving averages are converging to the upside in a tight bunch.
Yep.
So these are as my basic lines. So if you're William O'Neill, okay, your textbook says you're not buying this stock until here.
Okay.
Right? This is your textbook Bill O'Neill entry point here. Okay. This is all too early. So I have found that putting on, size at these points where all the breakout watchers from up here, right? It went right earlier. I find is better the ones to new all-time highs. I'm at the point where I try and avoid this now because of all of that. I hate when they fail and come back in and shake around.
Yep.
So I've gotten to the point where I try to have all of my position on by here and at worst pyramid the last bit in here, right? So by the time this breakout is happening, I don't even have to participate. I can wait to see what happens if I want to take any, if I don't want to take any. But the declining tops line as the moving averages are coming up the right side. So this is what Stan Weinstein would call a stage 1 base. Stage 2 is when it goes from that bottoming pattern into the beginning of an uptrend through, right, that big down, the declining. And so from stage 1 to stage 2, that's my sweet spot. And even better if you've got a relative strength line. In this case, it's not doing it. making new highs ahead of price. I'm always looking for that. That's like my bonus. So if, I see 20 setups all the same and 2 of them have RS lines making new highs ahead of the price, those are the ones I'm going to go with as long as the earnings are sound. So,
I want to pick your brain on pyramiding. You just said that you will pyramid. So large part of your investment will go at lower levels, and then there will be more added in the first, I think, stage 2, right? That's what you said. So what is going to be the quantum of pyramiding? How does it work? The ratio?
I suggest starting, figuring it out small always, and then as you get comfortable, increasing it. So, I'm good with 30 and 40% positions. So what I try to do is have, let's say, 5 or 6 total positions. Usually 2 or 3 is most of my account. And then I have a couple performance enhancers. So when I'm looking to build, I know at least a 25, 30, maybe 40% position. I've also learned from Rai, who no one knows yet. He's the best trader on the planet. You eventually want to have him on. I'm not even joking.
Who?
Amit Rai, my business partner. He's very modest, but he's the man. So that's why I tell you, I've learned a lot from him. I've learned a lot from Richard and Nick. I learned a lot from. You'd be surprised how much I learned from so many young guys. Listen to everybody. So, yes. And so from Rai, he's made it very clear, and this is an important thing. And Bill O'Neill would tell you the same thing. If you start putting, pyramiding too much further on, it can really mess you up on a stiff pullback that is ultimately not going to break the stock, right? Like maybe short term, it shakes you out, but it's ultimately fine. So I'm trying to get as heavy as I can early on volume. So I'm trying to get as much on. If the volume is there, even if I'm below moving averages as we're going through the declining tops line, if it's a powerful move on big volume, I'm going to at least start a position, right? So maybe only 5% of my potential 25, 30%.
Okay.
But as it's coming through, I'm watching, this is my next important area. I know that between here and then here, at this breakout area through here, I will take the chances, right? This is highly failure prone. I have noticed these earlier breakouts well before that base breakout, the William O'Neill textbook base break, they work a lot better. There's a lot less people watching down there for whatever. I've noticed the fake outs, and I call these early entries. I've call them consolidation pivots, like early consolidation pivots along the way. And so I'm much more comfortable putting on, let's say 5% here, another 15 to 20% as it goes through this line on the breakout. And then maybe if I want to add more here, I can. Usually by the time we have this much of a straight up move, I'm leaving it alone to see. It's amazing to me when I see them just blast off and go straight through. So to me, I'm more comfortable adding another 5 or 10% here, let's say, if I wanted to, than I would be here, even though it worked. Because Bill will tell you stocks that break out, things that move too straight up off the bottom into new highs are more failure prone than the ones that take a little breather, consolidation, or a little more time before they break out.
Okay. Ross, this is entry, staggered entry. How about exit? Would you exit at one price, or you also stays the exit?
So again, like once I get a stock that breaks out, I'm specifically looking for ones with a particular personality. And you might say, Ross, how do you know a stock's personality? Well, I look to the left, right? So that doesn't work with an IPO that gives you minimal to nothing. But if I can look to the left and see that a stock in the past, let's say it's been a big leader that's setting up again, and in its past 2 or 3 runs, it clearly respects its 10 and its 21 day, or let's say it's a stock that just happens to respect its 10 and it's going to be one of those silly ones that respects the 23-day exponential, right? So if I notice it likes the purple line better than the blue line, just to keep it simple, then the purple line is what I go with for that stock.
Okay.
And I will trade that. I have very specific rules for when it breaks the 10-day. I might sell a third on the second close below the 10-day. And by the second close underneath the 21-day, a meet rise style, again, from him, I'm gone.
Okay.
And if it goes again, I don't care if I have to buy it back higher.
That's great. Amazing. Beautiful.
Yeah.
Let's talk about another stock from India. Let's say Sagility, Sagility. Okay. So I'm asking questions on these stocks because I'm looking at these stocks right now. So that's why I'm asking you.
I love like this makes me drool, this massive breakout, right? This IPO U-turn. And I will say that I love that after the IPO, it immediately undercut the IPO low. Most IPOs, before they actually break out and work, will do that. Not all of them, but most. So I always love to see that. So if I didn't participate in this, I know, right, I'd probably get sucked in here. I'm one of these guys that, I'm watching these things because I want to see it turn again, because if I see it do this, I think it can do it again.
Okay.
And so I can't tell, I might get sucked in trying to buy through, in here and get spit out again. But this is another Amit Rai thing. Highest volume ever is a very big deal. And I'm going to mix this with the Dr. Wish green line breakout. You now have this big cup-shaped base. You see how it broke out to new highs, but came back in? This is what Bill O'Neill would tell you, because it went straight up from so low in the pattern to break out to new all-time highs. And you can see it squatted, but that is more failure prone than, let's say, had it gone up and consolidated a bit and then gone up a little bit more and consolidated a bit and then broke out to new all-time highs. That sort of thing is less failure prone than what he used to have an acronym for SUOFB in his messy handwriting all over his charts. I was lucky to get to see his chicken scratch, and that was straight up off the bottom. SUOTB, yeah. SUO, straight up SUOTB, straight up off the bottom. And so that's something I've kept in mind anytime and that's why I also love these earlier entries. So this is not surprising because it comes on the highest volume ever, and it looks like that it was an earnings catalyst. My guess is I'd be watching this one. Who knows? Maybe I watched the same thing as you. Maybe it pulls back all the way to there, but likely not. Just because it is so powerful, I start looking back to the left, like, we don't have crosshairs on here. Let's just see where it is right now. That's the gap right in there. Right. So the gap, it looks like there's a gap here for starters, just because, why am I picking that? Just because I'm watching today's low, right? This was today's session, correct? Yeah. So let's see how it handles this gap area. And if it starts to U-turn from here, if it shows me that, so I'm always going to watch where's logical support and how it may handle that area. And then once I see it start to, let's say, do this sort of thing, start to turn, is when I'll draw, even if it's a very short-term declining tops line, and wait for the volume to push it back the other way and try and cheat it before this. Because that's the breakout that the whole world is watching, right? That green line breakout to new all-time highs out of this, I can't see how, my eyes are bad, however many month base that is. Is it a little over a year? Not quite a year? Not quite a year. Or is it a year? Regardless, that, the breaking out of a big long base like this on the highest volume ever, earnings catalyst so far, this looks very constructive. I would keep an eye on it, but I'd be watching for it. I'd just be watching to see where it settles out and tries to turn back up again. And that's, so I keep it very, and then I'll
add a small position, like 10 to 10, 15% position. Would you like to add a small position?
So what I do is it depends on how I'm buying the stock, but if this was, let's say this is a potential new leader in a powerful group, that had all of the CanSlim characteristics, and it was showing this setup. I would, let's say it qualified for me to put it on as a position trade. Yes, I would be looking to accumulate a 20% position.
Okay.
That's
If
like
you would
usually
ask,
like if I'm focused in on a stock that I want to put a position on, and it's a minimum of 20%, as much as 40.
Okay. Fair enough. So let me just ask one more question. There is a stock called Motilal, Moti.
Let's spell that one more time. I'm sorry.
Moti, Motilal. Yeah. No. Just we wait for it. Moti. Can you type it?
Yep. I'm sorry.
Moti. Yeah, this one. Motilal, the first one. Yeah. Let's see.
So here again, let me get just looking at that high, and let's scroll back, make sure. So that is, okay, so that isn't the all-time high. That is it
just made the all-time high and reversed from there.
Yes. So it's that similar thing again. And so first, I'll always look, what's the personality of the stock? How does it trade? Is it common for it to do it? So I'll look back to the left, and it looks like there's plenty of times that it can break out, and while it might pull back, it holds up relatively well. So the fact that this, tried to break out and then immediately came back in, isn't the end of the world. I have found that, and again, a lot of it doesn't always happen. I mean, this one has the power when it goes. So the fact that it didn't go this time, it makes me a little bit curious. I would also say this stock has gone from roughly, let's just call it, I'm going to come up here even to be conservative, call it 200 to 1,000, right? So it's almost had a 5-fold move, and now it's built this big late stage base that's broken out and failed. I don't know. So it's hard to take it in and of itself. What kind of stock? This is a financial stock, a banking stock?
Yeah.
I would be curious to see if the whole group looks like it's had a big giant run and is now building a big, it would just depend on how the group looks. This base right here is about how long? Roughly a year. So here's what I'm actually, this one's deep enough I'll take that all back. This has come down far enough for a reset. This becomes a new stage 1 base. So this on a re-breakout, I think I would be interested in.
Okay.
First through this line, right? And that being said, I've noticed a lot of the base breakouts that fail will try a second time, sometimes a third or a fourth time before they actually work. And what I've also noticed, because Bill O'Neill's rule is this: anytime you see a growth stock that meets the CanSlim fundamentals, so as long as it meets, you've got a stock that has the earnings, sales, all of that in line with CanSlim, it's breaking out of an early stage base, the majority of those stocks should never fall more than 7 to 8% from that pivot point.
Okay.
So in the case of CanSlim, 7 to 8% is not only that sweet spot where your losses start to really compound if they get out of control past there, right? So not only is that a mathematical thing, but O'Neill's study of the greatest winning stocks in history showed specifically that the stocks that meet those characteristics breaking out of an early stage base. So my point is the ones that will break out and fail a few times before they re-break out and work on that third time never ultimately fall 7 or 8%. So technically it still works. The problem is in a broad bull market, do you want to wait for a stock to fail 2-3 times, or do you want to be at where the money, where it's working, right? So it becomes an opportunity cost thing. So It's really been more of that, because I'm like, do the breakouts not work anymore? They don't work as much on the first breakout. That I would say. But believe it or not, as I look at a lot of the stocks that fail, and and I'm not saying it's this one, I'd have to run the numbers, but breakouts work better than people think these days. I think you just have to be very choosy with which ones you buy, the way they break out, how much volume is there, what the group is doing, that whole sort of thing.
Okay, fair point. What's the typical success percentage of a successful trader? Like out of 10 trades, how many trades will be right?
I'd say you're doing all right if you get half.
Half, okay. Even if you have 50%.
If I remember, 6 out of 10 trades is phenomenal. I mean, the statistics, right? From Jesse Livermore to Bernard Baruch.
Okay.
You can be right. You can literally, I mean, I can show you the math. They'll say less than a third of the time. You can be right as little as a quarter of the time and still make money, as long as you're hedging risk and position sizing correctly. So as Bill used to say, you can be right 1/3 of the time and still make a fortune in the stock market. I mean, that's the whole idea, is to be able to be able to maintain a statistically significant performance over the long term, right?
Yes.
So, and I would just tell you this: a lot of it is not losing money, right? If you want to, it's very funny. Mike Webster from William O'Neill. I shared my office with him in the very beginning in 1999. We shared an office together, and I still have his rules, which he has. It's funny. He shared it on Twitter, which was a photocopy from literally when we sat together that I have saved. And his number 1 rule: don't lose money. Number 2 rule: follow rule number 1. And how do you not? You're going to lose money, but it's losing, cutting your losers short, piling it onto your winners, but also understanding when it's a good environment, when things are working for you, sitting on your hands when the market's bad. I find a lot of people give their money away on that in between time, waiting for the next sweet spot. So
okay. And what's the typical risk reward ratio of a successful trader? Like,
so when I'm looking at risk reward, for me, I want to, I know a lot of people, R1, R2, R3, depending on how you do it. I want to know, I mean, me personally, I feel like when I'm putting on a trade, I want to feel like I'm risking a few percent to make a fortune, right? That's what I want to feel like. I'm always looking at a stock because I'm trying to get into the spot before it blasts off 50% or more. That's my ideal. However, at a bare minimum, I want to know if I'm, it's a 1 to 3, right? I want to know if I'm risking 1, I'm going to at least make 3. But in all reality, I want to risk 1 to make 50, right? 50. That's my, I'm saying that, the same way Bill O'Neill will tell you, you want to find stocks that have a minimum of 30% quarter-over-quarter earnings for the prior 3 quarters. Same thing with sales, yada, yada. However, he doesn't buy the stocks with 30% in earnings. He buys the ones with 800 massive triple-digit earnings for the last, right? So that's, if I can do it, that's me. I'm always, now that I'm older and I like less aggravation, I'm always looking for the sweet spot with that risk reward where I feel like I can risk 1 to 2% to make 100.
Okay. Lovely. Ross, it was such an amazing interaction with you. Short and sweet, but I think I exactly got what I wanted. Anything you want to add to the discussion?
I was just going to say this. I feel like it was a short amount of time. If you ever wanted to do more specific, like get some examples on, we'll talk before, and really hone in on it more. Because I don't know. I hope I wasn't too all over the place and it made sense, but I'm not inviting myself back, but I'd be more than happy to, if you ever wanted me to come go through more specific examples and that sort of thing, answer questions, whatever. So
I just want to
thank you very much. And
that would be amazing.
If I could do a follow-up and answer some questions and kind of tie everything together, I'd love to. So just let me know.
Well, what we can do is we can plan kind of a webinar for my Indian audience and let them come over and maybe they can have their right questions as well and you can answer them That will be interesting collaboration between both of us.
Yeah, maybe we could do something like, I mean, every Friday I do something similar. I do an hour and a half. It usually goes to 2 hours, but it's what we call the TML talk, the true market leaders. And so, yeah, it's fun for me. We get on and I go through my focus list and then we discuss any questions and stocks that anyone wants to talk about. So we do something
Okay.
like that.
Let me plan that one, and best of luck for your all the endeavors, and your
Thank
system
you
is
guys so much.
so
Yeah.
clear, so robust, and your experience clearly show me that you have actually built a system which is workable. And I request all my learners to look at the system closely. I am a big follower of relative strength as well. My whole life is around relative strength, so I can vouch for it that
Mhm.
any system with relative strength embedded inside it will have
Yeah.
high probability of success. There is no doubt about it. Thanks a lot, Ross.
Thank you so much for having me.
Thanks a lot, and best of luck for your future endeavors. Thank you.
Bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.